Hey guys, welcome back. Johnny here. In today's video, I want to talk to you about a company, JD.com, or ticker symbol JD. Now, I did have a subscriber ask me to do a video on this. Thank you for your video request. I did have a lot of fun getting information and doing research on this company, so thank you for that. Alright, so here we go. Right now, JD.com, or JD, is selling for $36.15. They have about 66% growth in the past 5 years. In the last year, they're actually down about 20%. But that could possibly be an opportunity to buy. Now, 77% of analysts agree that JD.com is a buy, and 33,579 people own JD.com on Robinhood app alone. Now, for all of you that aren't familiar with JD.com, it's basically a technology-driven e-commerce company. It's kind of like an eBay, but in China. Its headquarters is in Beijing. It was founded in 1998, so it is an older company. They have a very high PE ratio of 281. That's something that I don't would really care for. It's a little high. I like PE ratios very low, around a 40 or 50 and lower. But they do employ a lot of people, 157,000 employees, and they have a market cap of $43 billion. So they definitely have a lot of money to work with. Their collections is software services, 2014 IPO, North America, apparel, retail, internet, 100 most popular, and e-commerce. Now, they're 9% lower right now than the average price to buy. That could be a good thing. We won't know until the earnings report comes out. Like I said again, 77% of analysts are saying to buy this company. On the buy summary, it says JD.com's nationwide distribution network and fulfillment capacity will be extremely difficult for competitors to replicate. The recent partnership with Tencent will allow JD.com to gain significant user traffic from Tencent's dominant social networking products in China. JD.com users base, with its relatively high disposal income, is an attractive destination for third-party merchants. On the other hand, for sales summary, overall industry competition might force JD.com to invest aggressively in the near term, which could weigh on profitability. Fulfillment infrastructure could be costly to operate, especially as the company penetrates lower-tier cities with lower disposable income and population densities. And Alibaba dominates Chinese online marketplace business. This could limit JD's growth potential. So, with that said, guys, I'm not really too fond of these companies that kind of go in and out of negative and positive earnings per share. Looks like they've been above water for a few prior quarters. We won't know until around August 16th pre-market what exactly their actual will be, because there isn't anything on estimated. I don't really care for that. If I don't see good information on what I'm reading and investigating on, then I won't buy into it. Now, JD.com from the street rating is saying that it's a C. It's a hold. They don't pay a dividend at the moment. And they actually don't even have a target price right now. So this stock really is kind of like, to me, I feel like it's in limbo. It could go good, it could go bad, it could go up, it could go down. It looks like there's a lot of volatility right now. Looks like it might have an opportunity to go up a little bit just from looking at some of the SMA lines. But overall, guys, I necessarily wouldn't invest in this company right now. I might see what happens after the earnings report on the 16th. Some of JD's highlights, they slightly outpaced the industry's average of 45.7% in revenue growth. And since the quarter, same year prior, this quarter, revenues rose 46%. Now, that did help boost the earnings per share, so hopefully we'll still have positive earnings per share on this earnings call. Their current debt-to-equity ratio is 0.38, which is extremely low, which means that they have successful management on their debt levels. But their net operating costs significantly decreased by $601 million. That's a 195% decrease from the same quarter last year. Now, that's pretty bad, I would say. That's a huge drop in sales. JD has outperformed the S&P index, declining 20% from its price level in 1 year. So that's not good. It's showing a decline. This is something that I would be very cautious with. It's something that I necessarily wouldn't invest in again. The P ratio is too high. They're not making enough money. I just don't believe that it's a good company to get into right now. If you guys still want to look at some more stuff, it's only 2 out of 5 on growth, 2.5 out of 5 on total return, 2.0 out of 5 in efficiency, 3 out of 5 for price volatility, 2 out of 5 for solvency, and 0.5 for income. So even that's kind of showing it's a little iffy. I necessarily wouldn't get involved in it right now. Again, just put it in the back of your watch list. Watch it. If it's something that you still want to invest in, I would wait and see what the earnings report says on the 16th. You know, it says that the stockholders' equity or net worth has greatly increased by 66%, so that does show some signs of growth. But again, guys, at this moment right now, I wouldn't necessarily invest in this company. So I'm going to rate this company as a hold, and if it's a bad earnings report, it would be a sell. I definitely wouldn't buy it right now, and if you're already in on this company and you're not really that bad on a deficit or on a negative return, I'd hold it and see what happens through the earnings report. If you're thinking about buying it, I wouldn't buy it right now. So I hope that helped, guys. I hope some of this information helped you to just be a little bit more clear on some of the decisions you want to make. If you ever want to do any of your own research, you sure can. I encourage it. And guys, you guys have a great trading day and a great weekend.